Assalamu alaikum warahmatullahi wabarakatuh. Allow me to introduce myself. My name is Ahmad Rizki Pranata, and my student identification number is 234111015. In this presentation, I will discuss a topic that has been assigned as part of my course requirements. The purpose of this presentation is to explain the main concepts, theories, and important aspects related to the topic in a clear and systematic manner. I hope that the information presented will be useful, increase our understanding, and provide valuable insights into the subject being discussed. Without further delay, let's begin the presentation. Okay, on the first slide we will discuss the meaning of Financial Reporting Quality Assessment. Financial Reporting Quality Assessment is a process to evaluate whether the financial reports prepared by a company have provided relevant, reliable, transparent and useful information for users of financial information. In the business world, financial reports serve not only as administrative documents but also as a means of communication between companies and various stakeholders, such as investors, creditors, the government, and the public. Therefore, the quality of financial reports is crucial. Quality financial reports must accurately reflect the company's financial condition. The information presented should fairly reflect the company's situation so that users can make informed decisions based on it. From a corporate governance perspective, the quality of financial reporting is one of the primary indicators for assessing a company's level of accountability and transparency. The better the quality of financial reporting, the higher the level of trust it commands from stakeholders. On the other hand, if financial reports contain inaccurate or misleading information, this can lead to errors in decision-making and potentially harm many parties. Therefore, assessing the quality of financial reporting is a very important aspect in creating good corporate governance. Next, on the second slide, we will discuss the importance of quality financial reporting in corporate governance. The quality of financial reporting plays a crucial role in supporting the implementation of corporate governance principles. One of its primary benefits is reducing information asymmetry between management and shareholders. Information asymmetry occurs when management has more information than shareholders or investors. If this situation is not managed properly, it can create conflicts of interest and undermine trust in the company. Through quality financial reporting, companies can convey information openly and transparently, ensuring that all parties have access to the same information. This allows for a more objective decision-making process. Furthermore, the quality of financial reporting also significantly influences investor confidence. Investors tend to be more attracted to companies with clear, accurate, and reliable financial reports. For companies, a high level of trust from investors can facilitate access to funding sources and improve the company's reputation in the market. Furthermore, high-quality financial reports also assist the Board of Commissioners and Audit Committee in carrying out their oversight functions. With accurate information, they can more effectively evaluate management performance. On the third slide, we will discuss the indicators used to assess the quality of financial reporting. The first indicator is information relevance. The information presented must be useful to users and aid in the decision-making process. The second indicator is the reliability and accuracy of financial information. This means that the information presented must be free from material errors and reliable for users of the financial statements. The next indicator is transparency in information disclosure. Companies must disclose necessary information clearly and not conceal important facts that could influence user decisions. Furthermore, there is consistency in the application of accounting standards. Consistency is important so that financial statements can be compared from one period to the next. Then there's the timeliness of financial report submission. Information delivered late often loses its value and usefulness in the decision-making process. Another indicator is completeness of disclosure, or full disclosure. Companies must provide sufficient information to enable users to understand the company's overall condition. In addition, the quality of financial reports can also be seen from the low level of profit management practices or actions aimed at manipulating profit figures for certain interests. Lastly, there is compliance with applicable regulations and financial reporting standards. This compliance demonstrates that the financial statements have been prepared in accordance with established rules and principles. The better a company meets these indicators, the higher the quality of the financial reports produced. In closing, on the fourth slide I will convey the conclusions of the material on assessing the quality of financial reporting. Assessing the quality of financial reporting is a very important part of corporate governance because it is directly related to transparency, accountability, and stakeholder trust in the company. Quality financial reports must present relevant, reliable, transparent, and complete information, and be prepared in accordance with applicable standards and regulations. Quality information will help investors, creditors, and other parties make more informed and rational decisions. Furthermore, the quality of financial reporting also plays a role in enhancing a company's reputation and strengthening the relationship between management and shareholders. The better the quality of the information provided, the greater the level of trust a company can build. In the implementation of corporate governance, the quality of financial reporting is not solely the responsibility of the accounting department, but also involves management, the board of commissioners, the audit committee, and the independent auditor. All of these parties have a role in ensuring that the financial statements produced accurately reflect the company's true condition. Therefore, companies need to continuously strengthen their internal control systems, increase the effectiveness of supervision, and consistently apply corporate governance principles in order to produce high-quality and reliable financial reports. That concludes my presentation for today. In summary, the topic discussed provides important knowledge and insights that help us better understand the concepts and their applications in both academic and practical contexts. I hope this presentation has been informative and has contributed to a deeper understanding of the subject matter. Thank you for your attention and for taking the time to watch this presentation. I sincerely apologize for any mistakes or shortcomings in my explanation. Thank you once again, and have a wonderful day. See you in the next presentation. Wassalamu alaikum warahmatullahi wabarakatuh.